If China were to cut off oil trade with the US and instead import oil from Canada with a 0% tariff, it would be a major geopolitical and economic shift. Let's break it down. 1. Impact on the US. Loss of a major buyer. China is one of the largest importers of oil globally. If it stops buying from the US, American oil producers, especially shale oil companies, could lose a significant revenue stream. Lower oil prices in the US. With reduced Chinese demand, US oil prices might drop, hurting American oil companies and investors. Increased trade tensions. This move could escalate trade disputes, making it harder for the US to negotiate deals with China and other sectors. 2. Impact on Canada. Boom for Canadian oil exports. Canada is already a major oil supplier, and securing a tariff-free deal with China would give Canadian producers a massive advantage. Higher oil prices in Canada. Increased demand from China could drive up Canadian oil prices, benefiting producers but potentially raising domestic fuel costs. 3. Did Trump make a mistake? If Trump's policies, such as tariffs, sanctions, or aggressive trade measures, pushed China toward Canada, then yes, it could be considered a significant miscalculation. The US would lose economic influence over China, while Canada would gain a stronger trading position. 4. Real-world feasibility. This scenario is unlikely in the short term because China values diversification and buys oil from multiple sources, including Russia and the Middle East. US oil is still competitive and a full trade cutoff would be extreme. Canada's oil industry has infrastructure limits, making it difficult to immediately replace US supplies. If Trump's actions pushed China to favor Canada for oil, it would be a strategic blunder. But whether it's a fatal mistake depends on how the US adapts.